Hey, what's going on? I'm Dan Keller with MyMortgageGuyDan.com. I've got the smart glasses on today, and I've got my smart tie on because I'm diving into a very touchy topic, and that is adjustable rate mortgages. Okay, I've been talking a lot with builders, homeowners, and a lot of first-time home buyers lately about the 5/1, specifically about the 5/1 FHA ARM. Now, before you turn this video off, I want you to understand the ARM, the quote-unquote adjustable rate mortgage that America was hurt on or has the big fear of is not the FHA 5/1 ARM. And I'm going to explain down below in this blog exactly what I mean by that. But the FHA ARM is much more conservative, and in the event that it does adjust after the 5 years, it adjusts with a cap. And it adjusts, and I'm going to show you in some graphs in a second, that if and when it does adjust, the maximum it could adjust is 1 percentage point. Now, will it adjust 1 full percentage point? Probably not. But we have to, for the sake of discussion, down below I outline worst case scenario. So I'm going to put up, real quickly, I'm going to put up a chart. And as you can see, over the last, I think this chart dates back to 1990. From 2009 to 1990, as you look here, there is not a 5-year period in a row where, and this is the 1-year CMT, 6-month T-bill, and 3-month T-bill. These are indexes that the 5/1 ARM are attached to. You can see that there is yet to be a 5-year period where interest rates went up every single year. I think the biggest gap is from 2004, June of 2004, to where it peaked and started coming down in June of 2006, July of 2006. So, as you look at that, I think that's something that's really big to consider. Another chart that I'm putting up that I'll show you right here is the 1-year T-bill index. And this is current. This is up to 2011. And as you can see, from 1994 to 2011, and follow it across. Let's just look at 2010 for an example. From January to December, look at how little that index changed, okay? Look at down in 1994. Now that did change up from 3.54 to 7.14, but let's compare January of 1994 to January of 1999. It went up over 5 years from 3.54 to 4.51. It did not go up every single year, gradually higher and higher. So getting to my point here, you guys, this is a great way to look at taking advantage of a really low interest rate. One of the big reasons why I made this video is the gap right now between a 30-year fixed and a 5/1 ARM is greater than 1 percentage point in interest rate. So I'm locking right now, we're in March of 2011, and I'm locking at 4.625 on a 30-year fix with no buy-down points. You could literally get 3.5, 3.75 on an FHA 5/1 ARM, and that's amazing right now. So you're paying less money in interest, more money then goes to principal, therefore you're paying down your principal balance quicker, and that's a great way to fight this equity problem that a lot of homeowners are having, and this appreciation problem, or the naysayers are saying that we're not going to appreciate for some time, or we're starting to see some appreciation on the other side of the spectrum. So this is a way to pay down your mortgage much faster, pay less money to the bank, and profit more on your house or your nest egg, if you will. So at any rate, if you have any questions on this, I want you to look down below. I detailed it pretty thoroughly, and I also, for the sake of discussion, used worst case scenario examples, okay? If you have any questions, please contact me directly. I'd love to give you a mortgage analysis where we compare a 5/1 FHA ARM with an FHA 30-year fixed, and we'll go from there, okay? Take care.